Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks slip for a fourth session as traders dial back bets on Fed rate cuts, while oil climbs to its highest in more than 4 months on new US sanctions against Russia. China's annual trade surplus, meanwhile, hitting a record close to $1 trillion. JP Morgan's Jamie Dimon says tariffs can be a useful tool if used properly, while Iqbal Khan from UBS tells us clients should diversify investments amid economic instability. We bring you our exclusive interview. Plus, Rachel Reeves returns from China, the British Chancellor hailing deals worth around $700 million after a week in which markets pummeled UK assets. Good morning, happy Monday. Another day, another reining in of those bets around the Federal Reserve. Just 28 basis points now priced in for markets this year. Just one interest rate cut then expected in 2025 after the jobs data of Friday came in hotter than many had expected, with the unemployment rate actually ticking lower from 4.2 to 4.1%. A total jobs number coming in at 256,000. You saw the sell-off in bonds again on Friday. Markets today readjusting to that. Equity stateside sold off heavily on Friday. European stock futures now looking lower by 0.3%. It's been a challenge session over in Asia as well. FTSE 100 futures here in the UK pointing lower by 0.2%. S&P futures after the sell-off of around 1.5% on Friday, currently pointing lower by 0.4%. NASDAQ 100 futures looking to lose 125 points. Let's flip the board and look cross assets. The treasuries, of course, that we focus on, but they are not trading today because Japan, or not at least for the moment, Japan is closed for a holiday. Treasuries will open, of course, for trading later in the day. Currently focusing on euro dollar and the pound. The bets around further pound weakness are being made. 121 right now on the pound. Further weakness for sterling, down 0.5% as we await that speech from Chancellor Rachel Reeves. Under pressure, of course, given the market rout in UK assets last week. Euro dollar also getting closer to that parity level. Strong dollar in the session, helped by higher yields, of course. 102 right now on the single currency. Brent is also a key story for us. The oil markets rallying on these additional sanctions on Russia. We unpack that for you this hour. $81 a barrel on Brent, and gold trading at 2,688. CPI and inflation data could be the next data point that moves these markets, of course, on Wednesday. Let's cross over to Asia right now, where, again, I've mentioned it's been a challenge session. Avril Hong standing by in Singapore. Avril.
Yeah, Tom, absolutely painful. If you look at the picture on Asia equities, ex-Japan, the benchmark at the lowest since August, fourth session of declines. And this is against the backdrop of elevated US yields, the greenback strength, really sapping appetite for Asia stocks at a time where they've already been facing pressure, no thanks to the pain in Chinese equities. And then you add to that those elevated oil prices. Indeed, if you look at Chinese stocks, they've pretty much pulled away and erased those gains that were driven by the massive stimulus package late last year. And you're seeing how, there's some expectation of the national team potentially stepping in the afternoon session. We'll be watching for signs of that. But ultimately, despite these signs of support, the PBOC governor talking about proactive policies, Chinese exports rising to a record given front loading. That's not helping given the tariff, the stimulus uncertainties. Flip the board, because that is also likely to pressure not just Chinese stocks, but Chinese currencies as well. And today we actually saw, flip the board, the PBOC actually coming through with measures to broaden support for the Chinese currency. So it was a strong fix. We also got verbal intervention. These are among the tools that it can use in its kit. But what was also really interesting was its tweaking of capital control, so allowing firms to borrow more from overseas. It remains to be seen how effective something like this will be, because there is ultimately an unwillingness to lend to Chinese companies. Now, flip the board again, because it wasn't just the renminbi that was hit. This was also a day where we saw the Asia dollar index. It's a gauge by Bloomberg of Asia currencies, excluding the yen, slipping to the lowest since 2006. Not just the renminbi that was affected, the rupee was also at record lows. So we're watching out for intervention from central banks in the region. Certainly, some of our analysts have already pointed out that for the likes of the rupee, for example, it's not just about the levels, it's about curbing volatility. For the yen, as you know, the weakness has been exacerbating the import inflation. We're watching for a big speech from the BOJ Deputy Governor tomorrow and potentially any signs of shifts in the inflation outlook. So this is what we're seeing across the board, given the shift in the Fed expectations. Tom.
Avery Hong in Singapore, thank you very much indeed. And as Avery mentioned, we'll be watching to see if the national team rise to the rescue of those Chinese stocks later in the afternoon session, of course, in mainland China. Meanwhile, traders are looking ahead to US inflation data. As I mentioned on Wednesday this week, could be the next big one in terms of how these markets adjust to Fed expectations. Expected to cool only slightly against the backdrop of a resilient labour market, of course. We had a reminder of that on Friday, and a strong economy. For more, let's bring in Bloomberg's Valerie Teitel watching the markets for us. Valerie, are you hearing anyone mentioning the H word when it comes to the Fed right now?
Tom, we are getting very close to hearing from a major bank out there calling for a hike. Bank of America out on Friday saying that cuts, Tom, they're so 2024. They're moving the conversation to hikes, and they see no more Fed cuts left on the table in 2024. Also slashed expectations from Barclays and JP Morgan and Goldman Sachs, all removing one more cut from their forecast. The conversation very much is, how close are we to that threshold to hikes? Many economists out there think that we need to see a resurgence in inflation, maybe core PCE breaching 3% in order to get that kind of narrative change for the Fed. But if you flip on and just see what's been going on in the equity market, because it is not pretty. We saw that 11 basis point rise in the front end in those 2-year yields. That has been sinking the equity market even overnight in the Asia session, down another 0.4% after that big slide on Friday.
OK, and we, of course, have the CPI, have the inflation data out on Wednesday. Above and beyond the US inflation story, what are the other risks events on the table for the markets?
Tom, we are getting very close to Inauguration Day for President-elect Donald Trump, due to take place 7 days from now. The market is bracing for any more leaks that we do get on the tariff story, so watch out for how that dollar reacts. We know that that's been mainly a traded by the FX market, and the Bloomberg Dollar Index hit fresh 2-year highs overnight. And we have heard many other comments about tariffs, one of which being last week we heard from Fed's Governor Waller saying he doesn't think tariffs are inflationary. Maybe they're getting a bit more accepted by the mainstream. We also heard from the CEO of JP Morgan, Jamie Dimon, maybe throwing his hat in the ring for support for these tariffs.
To me, tariffs are a way, are a tool properly used that can help get some of those issues resolved. Unfair competition, national security issues. You know, if like any tool, if it's misused, it can do damage too.
So, Tom, watch out for any further dollar strength. If we get any further leaks on the tariff story, we are 7 days away from Inauguration Day.
Yeah, Jamie Dimon, CEO, of course, of JP Morgan, giving his views on tariffs, the upside and the downside to that potential policy tool. Valerie Teitel, thank you very much indeed. Now, UBS's APAC president and global head of global wealth management says it will be key for clients to diversify investments amid political tension and economic instability. Iqbal Khan spoke to us exclusively at the UBS Greater China Conference.
We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
OK, Iqbal Khan speaking to the team on the ground there at the UBS China Conference. Checking some lines right now, crossing in the last minute or so from the ECB's Ollie Lane, saying that inflation pressures will continue to ease this year. The ECB's Lane as well saying we do not want rates to remain high for too long. We need to ensure that interest rates follow a middle path. So some lines crossing here from the ECB's lane, currently at 102 euro dollar. And just checking in terms of traders pricing around the ECB through this year, expectations you're going to get around 91 basis points of cuts between now and the end of this year. So still expecting, as rates moderate in terms of expectations around the Fed and the BOE, the ECB is still fully expected to be on cutting cycle through this year. And you've had a reminder of that from the ECB's lane, saying that inflation pressures will continue to ease. But could oil prove a challenge to that inflation trajectory? Oil hitting its highest in more than 4 months after the US announced fresh sanctions on Russia's energy industry. A barrel of Brent now fetching more than $80 for the first time since July. Let's bring in Bloomberg's Stephen Straczynski, who's been covering all of this for us. Stephen, talk us through the impact that these sanctions have had on the global oil markets, the details, why they are proving significant.
Well, this is the first time that the Biden administration, as their last sort of act, is putting real sanctions across the board on Russian oil. You know, they've hit the insurance companies. They've hit about 2 companies that handle 30% of the crude that comes out of Russia. And they've also hit over 150 oil tankers. All of that is much larger than the packages that they've done before, and will make it more difficult for Russia to continue shipping crude, well, as long as incoming President Trump doesn't overturn it. Now, looking at the impact, some of the banks and analysts are saying that this could affect 800,000 to about shy of 1 million barrels a day. That's about 1% of global crude supply. That would affect mostly markets like India and China that were taking more Russian crude. And I have to remember that before this, the Biden administration was a bit more, they were taking a step back when it came to Russia and oil. They didn't want to cause any disruption to supply because that could affect prices. And on top of that, they put this price cap sort of mechanism in place to kind of reduce the amount of oil revenues that Moscow was making while keeping the barrels flowing into the market. This is a sort of turnaround to that policy and also a test for Trump.
Stephen, what then, given the action that we've seen and the fact that this is pretty broad-based, it is having that impact, what are expectations when you listen, when you're speaking to analysts in terms of how the oil story pushes forward from here in terms of pricing, with Brent now above $80 a barrel?
So there are 2 sort of things that the market will be watching closely. One will be, how effective are these sanctions? Will they stay in place? Will they actually reduce the amount of crude coming to the market? As I mentioned, some banks are saying this could affect as much as 800,000 barrels a day of oil being exported out of Russia. If that is the case, then you could see oil, which is in the $80 range, kind of trend more towards $90. There is no expectation that you're going to see a spike like we saw in 2022 after the war in Ukraine began and we were above $100 for Brent. Instead, you're going to see sort of a ratcheting up of prices where maybe the market wasn't expecting that. The second thing that you're going to have to watch as well is Iran and what Trump does with Iran. Trump has sort of said that he will put a tougher sort of stance on Iran and maybe enforce sanctions that have been in place that could also reduce the amount of oil coming out of that country. Further, another bullish element pushing prices up. But again, I do have to say that there isn't, as far as we've heard, any expectation that you're going to see any big spikes like we saw in 2022 in the oil market.
OK, so more likely a grind higher than a big spike. At 81.21 right now on Brent, up 1.8%. WTI at $78 a barrel, up close to 2%. Bloomberg, Stephen Straczynski, always with the finger on the pulse of these oil markets with the analysis. Stephen, thank you. Here's what else we'll be thinking about then for the week ahead. On Tuesday, we're going to get the French PM outlining their agenda. So that will be important, of course, given the pressures on the cabinet of France from both left and right. So that agenda will be detailed on Tuesday. Meanwhile, on Wednesday, banking season, earnings season kicking off with US banks. That will be consequential. We'll be breaking those for you, of course. We have the likes of Goldman Sachs, Citi, Wells Fargo and JP Morgan all reporting. And, of course, comments from executives in terms of the outlook will be crucial as well. And on Friday, we got euro area CPI. So inflation data out of the US on Wednesday. Then on Friday is the euro area's turn, as we hear from Philip Lane this morning of the ECB saying that inflation pressures will continue to ease this year. We'll see if the data on Friday confirms that view from the ECB's Philip Lane. Coming up, the UK Chancellor returning from China with deals worth about £600 million to the UK economy. We'll be discussing the state of relations between London and Beijing next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Monday, everyone. Traders in the options markets are preparing for the pound. Couldn't possibly be that happy for UK assets. The pound possibly to tumble as much as 8%. 8%. Hold on to your hats. Following last week's sell-off across UK markets, the pricing will be unwelcome news, to say the least, for Chancellor Rachel Reeves as she returns from her trip to China. Bloomberg's UK correspondent Lizzie Burden is here. Did Reeves get anything out of a trip that turned controversial, given opposition calls for her to scrap it? Did she come back with anything meaningful?
Well, she came back with £6 million worth of deals to boost the UK economy. This is the big number that she's touting. Yeah, 600 million.
Right, OK.
Did I say 6?
You said 6.
It's very early on a Monday morning.
Either way, it's a pretty small number in the context.
It is. And though, however, she is saying that the long-term benefits would be up to £1 billion. And, of course, growth, the top priority of the UK government. So the signal by her actually going is that the Labour government is focused on long-term economic growth. Interesting, she met with the Chinese Vice Premier in Beijing, officials agreeing to deepen financial services links, lift certain export barriers. We talked, hadn't we, about whether it would be possible to split the trade and investment story off from the geopolitical story. And she was brave. She managed to go in and raise the issues about China's support for Russia's defence industry, interference in the UK's national security, human rights issues as well. So not seeing a need, apparently, to split the two sides of the coin from each other. For China's part, and Tom, you'll know this well, Beijing really trying to shore up its relations with America's friends before Donald Trump returns to the White House. So you've seen Xi on the charm offensive with Japan, with Australia, with India as well, doing what he can before another round of tariffs kicks in. This UK visit from Rachel Reeves is just another part of that.
Did the market turmoil at home overshadow this visit?
Well, for UK reporters, of course, this is the front and centre at the moment. There had been this pressure for her to cancel the trip. She responded that her fiscal rules are non-negotiable, which basically acknowledges that if the fiscal watchdog, the Office for Budget Responsibility, when it comes back in March, says she has no headroom, then she is going to have to make a choice between spending cuts and tax rises. And she, of course, has indicated to us that her choice would be spending cuts because she's already done the tax rises in October. We'll have to see whether this messaging is enough to calm the markets at the open. You talk about what the indications are for traders in the options market, an 8% fall in sterling potentially today. Cable already at its weakest since 2023. And as you remember last week, the 10-year gilt yield at its highest since 2008. So really interesting to watch the moves in the UK market at the open. But for the UK government, trying to move the focus on. Today we'll get a speech from Keir Starmer about AI. So again, trying to emphasise how Labour is going to grow the economy in the long term rather than getting bogged down in the market moves.
What is the significance of that AI strategy then for Keir Starmer? What details are we expecting on that front?
So Starmer's going to promote this as a key area of growth, an action plan, 50 recommendations. We've got missions recommendations, all of these things. But the point is to have AI growth zones where it's easier to have planning for data centres in special districts to be built. They could use nuclear to power them because, of course, we know that it's energy thirsty. And it's part of this plan to grow the economy, the idea being to harness AI for public services. They want these supercomputing projects. They want to attract technical talent to the UK. But given the moves in the bond market, what the moves tell us is that investors haven't much faith in the government's ability to manage debt. So will investors be persuaded by these ambitions on AI? That's the
Lizzie
question.
Burden, thank you very much indeed. That speech from the Prime Minister coming up later today, detailing some of those aspirations around AI. Our UK correspondent and, of course, anchor of the opening trade as well. We're going to have more, of course, on Rachel Reeves' visit to China later in the programme. We're going to be joined by the chair of the British Chamber of Commerce in China. That conversation at around 6:45 a.m. London time. Now, Jeff Bezos' Blue Origin space team are counting down to the inaugural launch of its New Glenn mission. You can see live pictures right now of the Blue Origin mission feed showing the rocket on the launch pad at Cape Canaveral in Florida. If all goes to plan, New Glenn is set to launch later this morning. I'm looking at the ticker ticking down, the timer ticking down to around 30 minutes and 26 seconds. We will bring you that live when it happens. This is Blue Origin's New Glenn space rocket, which will be going up with a test satellite and with the aspiration of landing the rocket's lower portion on a drone ship in the Atlantic Ocean. Live pictures. We will bring you that launch if and when it happens. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, at least 2 rounds of hot, dry Santa Ana winds are expected to blast through Southern California early this week. The powerful gusts are expected to challenge fire crews struggling already, of course, to contain 2 destructive blazes and could force thousands more residents to evacuate. For more on this, let's go to Bloomberg's Ben Sharples with the details. Ben, what is the latest then on the ground?
Hi, Tom. Yeah, LA is facing much more challenging conditions again. There was a brief respite over the weekend with the winds died down and allowed fire crews to contain the Kenneth fire and make serious inroads into the Hearst blaze. But the National Weather Service has issued some red flag warnings, some of their highest alerts, and warning of worsening conditions in some counties of LA and Ventura. And part of those alerts, they are warning of the risk of large fires and the rapid fire spread. So it's certainly going to get much more challenging from Tuesday morning onwards. Tom, I'll just run through a few of the numbers for you. At least 24 dead. That's the death toll at the moment. There's still over 100,000 people under mandatory evacuation orders. There's 12,000 structures that have been razed. AccuWeather, the commercial forecaster, has raised its estimate for damages and economic losses to between 250 billion to 275 billion. Just bear in mind that their estimates usually take in direct and secondary losses. And the 2 biggest fires, Palisades and Eaton, they still burn. They're still largely uncontained, and they've scorched so far almost 30,000 acres, or 38,000 acres rather.
I mean, so some remarkable statistics that concerningly are likely to rise from here. What is the biggest worry right now?
Tom, the biggest worry is the winds, the strong winds. Strong winds, they make it harder to fight fires. They spread flames and embers far and wide. And that just stretches fire crews in their efforts to try and combat the fire. And especially when you take into account that Palisades and Eaton, they're still largely uncontained, so it'll just stretch resources. The National Weather Service is saying that we probably won't see the windstorm that we saw early last week, and that windstorm prevented firefighting aircraft to fly and combat fires, so we won't see that. But fires whipping up is just going to make it so much harder for the crews. So from Tuesday morning, early Tuesday morning up, for about, and the next 24 hours after that, it's going to be a very, very tricky and challenging period for LA.
Ben, briefly, what do we know about the economic costs, the economic toll of this disaster that, of course, as you detailed for us, continues?
We've had a few estimates at the moment. AccuWeather, the commercial forecaster today, raised their estimate to between 250 billion to 275 billion. Now we just got to take into account there that they have direct and indirect losses from wages lost to supply chain disruption. So that's why it's such a big number. JP Morgan last week, we're talking about insurance losses up to $20 billion. So it's big. It's big and it's likely to get bigger.
Ben Sharples. Ben, excellent update, important update. Thank you very much indeed. Coming up, the world's bond market, of course, leading a rise in global yields. What does it mean for the equity markets? We bring the details and analysis. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks slip for a 4th session as traders dial back bets on Fed rate cuts. Oil climbing to its highest in more than 4 months on new US sanctions against Russia. China's annual trade surplus, meanwhile, hitting a record close to $1 trillion. JP Morgan's Jamie Dimon says tariffs can be a useful tool if used properly, while Iqbal Khan from UBS tells us clients should diversify amid economic instability. We bring you our exclusive interview. Plus, Rachel Reeves returns from China, the British Chancellor hailing deals worth £600 million after a week in which markets pummeled UK assets. Checking the markets where UK assets will again be under the spotlight. The pound under pressure today as traders ramp up their bets of further downside for the pound. Before we get to that, European stock futures pointing lower by 0.3%. FTSE 100 futures looking to lose 12 points. S&P futures pointing lower by 19 points, off by 0.3%, and Nasdaq 100 futures down currently by 0.5%. The jobs data of Friday, strength, 256,000 additional non-farm payrolls added, and an unemployment rate moving from 4.2 to 4.1%. Markets again dialing back expectations for Fed cuts this year. Bank of America saying they are done. No more cuts, says B of A, at least for this year for the Fed. Let's flip the board and look cross-asset then, with the 10-year still in focus, given the yield jump that we saw, of course, on the 2s and 10s on Friday. Treasury's not yet trading because Japanese markets are closed. Euro-dollar at 102 on further strength from the dollar. The pound at 121, down again, 0.4%. The pound again feeling the squeeze. Brent rallying close to 2% on those additional sanctions, and gold trading a little higher at 2,690 on the yellow metal. So the US government bond yields have, as we've been discussing, been surging, with the 10-year note yield now approaching 5%, a level, of course, not seen since before the global financial crisis. And the message from the markets is getting clearer by the day. Get used to it. The market action is the subject of today's Big Take. Let's bring in Bloomberg's Valerie Teitel for the analysis. Valerie, is this the real higher for longer that some have been forecasting?
Hey, yeah, that's right. That term higher for longer that we heard so much by the Fed. It's seeming now we're feeling the effects of that, not in the front end of the bond curve, but in the long-term interest rates, these 10-year, these 30-year interest rates that are hovering around 5% in the U.S. Seems to be something that, you know, the market could have to live with, not just temporarily, but for an extended period of time. So perhaps the higher for longer mantra that we heard from the Fed is really more about higher for longer when it comes to long-end Treasury yields. We've seen a very interesting dynamic when it does come to what the Fed's done and what long-end yields have done. Normally, when the Fed enters into a cutting cycle, that happens alongside the U.S. economy turning around, and we see a big rally in bonds with yields headed lower. We've not really seen that this time around. Maybe you call it a soft landing, the fact that the Fed is cutting into not a recession, but into a slowing economy, seeing these yields rise alongside the Fed is cutting. And that's something we've really not had to live with for a while.
Yeah, it's economics 101 being thrown out of the window, isn't it? What are markets most concerned about in an environment of higher yields then?
Look, it is very interesting to see how global economies will absorb these higher yields. Many are pointing not to consumer debt being the problem, but it's public debt. It's these highly indebted nations across the world, a lot of which was exacerbated by the response from COVID. In emerging markets and in developed markets, we've seen debt to GDP ratios rise. If you have higher yields alongside a burden of debt, it really poses these questions about fiscal dominance. And to that era, or to that point, Tom, we've seen fiscal dominance talked about in developed markets. You know, here in the UK, it's very much a narrative, but it's also being talked about in EM. We've seen Hungary, Poland, Brazil, and Mexico, all these EM central banks noting that their ability to conduct monetary policy is being hampered by the fact that the governments are sitting on such a large debt pile that they can't hold rates high enough to bring inflation back to target without imperiling the trajectory, the debt trajectory of their own governments.
And the markets have been holding some of those countries' feet to the fire, haven't they? They've done that with France, they've done that with Brazil, now they're doing it to the UK. Valerie Teitel, thank you very much indeed. Today's Bloomberg Big Take. which, of course, you can get the details on Bloomberg.com and, of course, on the terminal. Now, the global head of UBS Wealth Management says that Beijing's more proactive fiscal stance will be as relevant this year to markets as what happens in the US. That's a big statement. In an exclusive interview, Iqbal Khan also told us how he sees a slower pace of Fed rate cuts affecting those investment decisions.
Well, generally, the entire rate curve and everything around rates policy, as well as inflation, has been a key topic and has now reignited again with what we're seeing in terms of the rate curve and what you just mentioned. There was a Bloomberg headline just this morning around scratching 5% in terms of 10-year yields. Having said that, we do still expect a gradual reduction in rates, but we will have to work through in scenarios. Why do I say that? We're waiting for an inauguration. We will see what the U.S. administration will be doing. There are scenarios out there. We need to work through those scenarios. We do believe that there will be continued rate cuts, maybe albeit a bit slower than anticipated, but this is something that we will have to work through.
You just said the Trump inauguration. He's threatened a lot of punitive issues, more protectionist American policy, including tariffs, as well as perhaps more debt issues. The deficit has been a problem in the United States. How do you see that impacting China in particular, which is trying to get some traction in its own economy?
Well, I think if you step back once again and you look at some of the macro challenges in China, we're talking about the real estate sector, we're talking about local government debt, and we're talking about consumer demand. We've started to see a commitment of China towards the economy, and we've started to see that economic policy come to bear. Everybody's, as you mentioned, waiting for March. We will see what the next steps around the more proactive fiscal stance will be in China. That will be as relevant as what the U.S. does.
You think that's what's going to happen in March? Because we've had some false starts, some false dawns, if you will, on the policy front. What would you like to see?
I think we would like to see continuous and sustainable steps towards addressing some of the more macro and fiscal challenges that China faces.
Will 2025 be tougher than 2024, though?
Look, every year, whenever we start a year, there's always this question, will one year be tougher than the other? One of the things that I've learned is don't always follow consensus. That was one of the things we learned when we went to Davos every year. Just think about scenarios, work through scenarios. You will always have additional information. One of the great things about GCC is figure out what is out there. What are the big knowns and what could be potentially the big unknowns, and how are you going to factor that in? Again, one of the key things that we are here to deliver is sustainable performance, sustainable impact for our clients. And we do that by making sure that their portfolios, their investment portfolios, are all-weather portfolios. And we work through this with our clients in making sure that they're diversified globally as much as by sector and theme.
Iqbal Khan, UBS Asia Pacific President and co-head of UBS Global Wealth Management, speaking exclusively to Bloomberg TV. Let's continue the conversation about what has been, of course, a rocky start to the year for global markets. With me now is Alexandra Ivanova, fixed income fund manager at Invesco. Alexandra, we'll talk about what's happened in terms of the equity markets wiping out, of course, the gains that have come through year to date for US stocks, and a lot of that down to higher yields. Where are we in terms of this market correction on the sell-off of treasuries?
Oh, that's a very good question, and I think it's a million-dollar question. Nobody knows, but to me, it feels like the yield rises have been to the point where it's becoming a little bit more difficult for equity market to sustain their valuations. I think some of the strategies we're talking about as we approach 5% yield on treasuries, we will be focused on how long-term valuations in equity markets will reflect that. And I think so far in 2024, the market has been so resilient, and we have seen a rise in rates since September, almost 100 basis points, and equity market has been ignoring it. But I think we're getting to the point where it's becoming a danger zone. So pullback is something that is not surprising for me. I think volatility is going to stay here. And for active managers, for us, it's not a bad environment. Watching the rates, something that I'm doing on a day-to-day basis now. But in terms of the equity pullback, maybe I'm waiting for some levels where we can get back into equities, but it's a little bit too early.
So we're close to that danger point. What are the kind of levels you're looking at to get you interested in equities and looking to add?
So 5%, I mean, naturally, we're all talking about 5% yields. Some people were talking about even 6% yields. I don't think we will get there. But
because buyers come in at 5%?
Yes, I think the level of yields at this level, with the carry is so much higher, you need to see the rates to go even 50, 60 basis points higher to start losing money on a 12-month holding period. And for you to lose money on 10-year yields, they need to stay there on a sustained basis, which I don't think is going to happen. We could get there. The dynamic in the market is such that I think we're going to get continued sell-off, but I think the valuations are coming to bond market.
Where does the UK sit in that danger zone? Does the spotlight remain on UK assets? Is there further selling pressure? Or are you looking to buy gilts at these levels?
I'm actually positive on gilts, not because of the dynamic and the fiscal, but mostly on valuations, because we've gone to the point where it's quite attractive, especially in the long end at the moment. And we have been seeing in the last couple of sessions that even when we saw some really strong payroll numbers coming in the US, the gilt market kind of sustained its level, so which means that there is lack of sellers at this point. And maybe we're not getting a lot of buyers stepping in yet, but at these levels, I think makes sense to start piling into some of the long end of gilt market.
Okay, so you're looking at maybe at 10s or 30s for UK gilts, but there's a sense of caution there I'm picking up from you.
Yeah, of course. I mean, when the market actually starts moving, it's very difficult to stop the dynamic and the momentum. The momentum is definitely on the rates higher.
Do you think we're underestimating what the BOE will need to do? There are some suggesting that actually the Bank of England is going to have to cut far more than markets expect.
I do agree with that, and mostly because the inflation picture, to me, it doesn't look like we're going to see the pickup in inflation massively. There are parts of the inflation, let's say services inflation is quite sticky, but that's more structural or very specific to UK market, the housing market, or some rents are very high. But underlying, the labor market is weakening. We are starting to see some weakness in certain parts of the economy that maybe it's not necessarily in the data yet.
A very quick one on the Fed. Is the next move a cut or a hike?
Cut.
Second half of the year?
Probably, yeah. I'm thinking that it's pushed back down. Okay. Our economists think that the second half of the year.
Okay. Alexandra, thank you very much. Indeed, Alexandra Ivanova, fixed income fund manager at Invesco, seeing opportunities in the long end when it comes to UK gilts, still sees the Fed cutting, but not until the second half of this year. Bank of America, of course, have changed their view to expect 0 additional cuts this year. Coming up, the UK Chancellor returns from China with deals worth about £600 million to the UK economy. We're going to be discussing the state of relations between London and Beijing. That is next. This is Bloomberg. Welcome back. Some lines dropping, according to reports from Reuters. The US has found that China unfairly dominates shipbuilding. This was a probe that was initiated in 2024 by the US Trade Representative Catherine Tai. And the findings are, again, according to reporting, that China unfairly subsidised its shipbuilding industry, unfair financial support barriers for foreign firms. We'll keep across that story for you. Reuters reporting that US probe has found that China unfairly dominates the shipbuilding industry. Now to the maker of iPhones, or in fact Apple, and its fortunes in the Chinese market. Shares of Apple's Chinese suppliers are lower this morning. That's after an analyst said expected iPhone shipments this year would fall short of Wall Street estimates. In a post on Medium, TF International Securities analyst Ming-Chi Kuo sees 220 to 225 million iPhone units shipped in 2025, compared with a consensus of about 240 million or more. Apple shares fell in US trading last Friday after the news. We keep across that story for you as suppliers to Apple face the pressure today. Staying with the China story, the UK Chancellor Rachel Reeves is returning to the UK from China, where she reached deals worth £600 million to the British economy over the next 5 years. Reeves went ahead with the trip at the weekend, despite last week's sell-off across UK assets. Let's bring in Julian Fisher right now, chair of the British Chamber of Commerce in China, joining us from Beijing. Julian, thanks for your time. We talk about the £600 million worth of deals. Was that the significant number that you and your members were looking for? What of consequence came from this visit?
I think, first of all, the fact that the EFD happened at all is significant. This is the first time in 6 years we've seen one between the UK and China. I think the fact that it happened so quickly and the fact that it comes hot on the heels of David Lammy coming to visit is also significant. But I think we should set expectations. As much as this is talking about $600 million worth of deals, the EFD is really around commitments. I mean, in terms of those commitments, there was, of course, because it's an EFD, a lot of stuff around financial services. We've seen openings in terms of quotas and licenses for HSBC, Aberdeen, Ascent Capital. There was discussions around green and dual currency bonds in the UK through the likes of Bank of China, and discussions around China's pension fund. So I think a lot of really, really positive stuff happening around UK financial services that will definitely have an impact. But I think it was also interesting to see what it might mean for small business as well in the UK, particularly around food and beverage and alcohol. So you've seen opening up for pet food, for greasy wool, for whiskey, and the long-awaited opening up of new pork markets in China.
OK, that's really interesting in terms of the financial services sector and the potential benefits that could come through, as well as FMB as well, and those businesses in the UK. Look, you've been on the ground there for around 2 decades, Julian. How would you characterise right now relations between the UK and China?
I think that we're at an incredibly interesting phase, and I say that very aware that Donald Trump is about to come into power. But ultimately, it feels like there might be an opportunity here for the UK to chart a slightly different path from the EU and from the US. It's pretty obvious at the moment that we haven't put tariffs on electric vehicles, and I know that that was discussed over the weekend between Rachel Reeves and her counterparts in Beijing. So there potentially are opportunities here for us to carve out, a different way of engaging with China. And certainly something we saw in our sentiment survey recently was that increasingly British companies are seeing opportunities to support Chinese companies that are going global. And, we must remember that the UK is a service economy and that our financial services, our legal services are world class. And I think that's something where our members have seen real positivity this year in helping China to navigate the global landscape as it goes global.
And what are the remaining challenges, the key challenges that your members bring up for you when it comes to that market share, that opportunity in China, at a time, of course, of slowing Chinese growth?
I mean, it's not been an easy time at all. In our sentiment survey in November, where we had over 300 businesses from across British businesses from across the country, this is the 5th year in a row that British businesses say that it's got more difficult to do business in China. I think some of that comes down to market access issues and regulatory issues, but we also need to understand it's just an incredibly competitive market here, and really low consumption and significant challenges to the Chinese economy. The sectors that were most optimistic were retail, advanced manufacturing and creative, but for very obvious reasons at the other end of that you're seeing really big challenges for anyone involved in the property sector and also energy as well.
Are you seeing a greater willingness, Julian, when you interact with your counterparts, your Chinese counterparts, a greater willingness to open doors and to try to attract that FDI that we know China wants? Is there a softening of the stance on some of these regulatory hurdles from China as they try to address the challenges of that economy?
So I think over the last 2 years, post-COVID, our access to Chinese government has been fantastic, and there's been a lot of desire to discuss. issues, but I think sometimes the gears don't quite fit. You know, we're sitting in a meeting room saying we really want to talk about market access issues, about regulatory change. You know, they're sitting in the same room saying, you know, what about FDI, what about investment? And I think that cycle seems to be continuing somewhat. So at the moment, you know, not just on a chamber level, on a business level, but also at the government level that you saw over the weekend, the question really is, you know, is China capable of kind of continuing reform, opening up and real market access for international business, or is it unable to fight its urge towards protectionism and kind of some of those bigger challenges geopolitically that really inhibit foreign business in China?
OK, Julian Fisher, chair of the British Chamber of Commerce in China. Really important context on this visit by Rachel Reeves and how the UK could potentially carve a different path in terms of that relationship versus the Trump administration incoming, of course, and arguably the EU as well. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Checking on a chart that reflects the unwinding of the Trump trade. Yes, part of that is down, of course, to reassessing how far the Fed will go. Bank of America saying no more cuts this year, even suggesting the next move could be a hike. That's part of it. Part of the risks around tariffs, of course, as well. And then the additional putting onto the market of all this additional debt and the deficit concerns. And here you can see, for example, the Russell 2000, one of the biggest beneficiaries, the small caps on expectations of tax cuts, for example, from the incoming Trump administration, has unwound those gains, is now in negative territory for the year. The S&P is not far off as well. So that trade has deeply unwound. Does that have further to go, particularly given the yield that you can now be picking up on a 10-year Treasury versus the earnings yield of the S&P, which is about 1% below that 5% level? And what happens? Do the buyers come in at 5% for the Treasuries, or do you march higher above 5% and start targeting 6? Big questions, of course, for these markets as you look at the pressure on US stocks. The pound, of course, also in focus. Further pressure on sterling today, down 0.5%. Markets traders increasingly betting that you could get below 120 on pound versus US dollar. That would be about 2% below where we ended on Friday. Some putting on bets that maybe you get below 112, which would be a move lower of about 8% for the pound. Rachel Reeves hopes to address this challenge this week. The pound in the session today under pressure again. Next up, we're going to speak exclusively with the Bank of Finland Governor and ECB Governor Council member Olli Rehn, live from the Asian Financial Forum in Hong Kong. The opening trade is next. This is Bloomberg.